Everyone, welcome to the class on management of insurance services. Today we will focus on the unit 11 of this course, and here we will discuss about the other types of insurance schemes and services available. In the past few classes, we have focused on the specialized type of insurance schemes like health insurance, like property insurance, and today we will be focusing on few miscellaneous insurance which are existing in today's market scenario. So our focus will be on personal accident insurance. We will see the overseas accident insurance and the health insurance. We will discuss about the burglar insurance, money insurance, fidelity guarantee insurance, commercial fidelity guarantees, the bankers blanket indemnity insurance, the jewelers block insurance, and other miscellaneous insurance. And finally, we will also briefly look upon the package policy. There are few insurance which comes in one package. So these are few miscellaneous insurance which will be our focus of discussion today. So when it is a miscellaneous insurance, that means under one particular insurance policy, there are several small insurance policies which are accumulated under one insurance policy. So miscellaneous insurance is a term of convenience used to collectively refer to all general insurance covers other than the main line of business, such as fire, marine, motor, engineering, and health. So here it is collectively under one insurance policy, there will be several other insurance covers. Like it can be fire insurance, it can cover fire insurance, marine, motor, engineering, and health insurance, and many more. So insurance subject matter can be a thing. So when we are talking about its coverage, the coverage can be on money, it can be on jewelries or any other valuables, it can be on your assets, or a situation which can be accident or theft or breach of trust. So multiple policies may be packaged together for convenience. So as I told that in a miscellaneous insurance, there can be multiple small policies which can be packaged under one particular policy. So insurers may cede risk and premium through reinsurance. So when one particular policy has different types of miscellaneous insurance coverage, so now insurance companies can minimize their risk and premium through the reinsurance. So they have to undergo the reinsurance schemes from another insurance company. New trends includes the rural insurance and government initiatives in case of a general insurance. So basic principles which are applicable to these types of insurance policies, we have already discussed about the basic principles yesterday also, and it is an overall the insurance schemes are based on these type of policies, which is the principle of utmost good faith, where both the parties, the insurer and insured, are responsible to disclose all the details to each other. The materialistic details need to be disclosed by the insurer, and the insurance company also. The insurance, the material disclosure has to be done by the insured person. That means the client or the customer, and the all the terms and policies or the guidelines of the insurance policy needs to be disclosed by the insurance company. Insurable interest, this also all of us have discussed, that principle of insurable interest is that here the insurance policy will be in the name of the person who is actually directly having the financial loss. So it has to be the owner or the person who is linked with the policy and who is having a financial loss. It may be the individual or the owner or the bank, etc. And the indemnity policy Indemnity principle, this also all of us know that we have discussed it yesterday, that it is in this principle the amount of loss that a person is having or an individual is having, that will be compensated in equal amount by the insurance policy. It cannot be more than that loss amount which has been suffered by that person. And here there are two corollary principles that we have already discussed, the principle of subrogation and the principle of contribution under indemnity policy. And in case, and the final principle, there are four principles, and the fourth principle is the principle of proximate cause. That means the main cause of the mishappening, or the cause of maybe the catching of fire, or what is the actual cause of the happening which has been under which the insurance will be covered, that has to be identified. So these are the basic principles based on which the miscellaneous insurance schemes also are applicable. So now moving on to the different types of miscellaneous insurance schemes. One scheme is known as the personal accident insurance. This is, as the name indicates, it is the accident of one individual. So an accident happens by chance and not under human control. So it is an accident is a thing which is not planned. It happens by chance. It cannot be predicted that accident will happen. So it is a happening by chance. So element of chance is very compulsory for a loss to be called as an accident. And which is not an accident? A suicide or an attempted suicide, which is intentional or it is planned but not by chance. And a special case, murders are also treated as an accident because the death is outside, the death of an individual is outside the victim's control. So it is also an happening by chance. So here, in some cases, murder also can be treated as an accident. For example, the slipping in the wet stairs and fracturing a leg is an accident. These are few examples, like, or intentionally harming oneself is not an accident, and being attacked and killed by another person is an accident, which is, so murder and any sort of accident is a chance happening by chance, so it is coming under the personal accident insurance policy. So insurance principles applied to the personal accident insurance policy is, the, as we have already discussed, the principle of utmost good faith. In case of personal accident, the person who has faced the accident has to declare each and every happening or incident properly, true to the details should be true, which should be properly calculated to the insurance company. So with the principle of utmost good faith, the proposal details must be true and complete, which is given by the individual who has met with an accident. So especially he has to tell about, so he can tell that yes, there was an accident which has incurred and some vehicle has come and hit him. But he also has to say that what is his occupation, where he is residing, what are his hobbies. It might happen that he might have faced an accident while he is drunk. So in that case, he cannot claim, his claims will be rejected. So suppose he might suppose he has met with an accident while he was talking over a mobile phone. So here the individuals who have undergone the accident has to give all the details in true sense, and complete details has to be given to the insurance company. A driver declaring himself as an office clerk, if suppose you are not declaring your own occupation, then when the fact you are not declaring, then of course the claim of the such type of personal accidents will be rejected. So this is based on the principle of utmost good faith. The next policy is the principle of insurable interest. A person has an insurable interest in self. That means the policy has to be directly or indirectly linked with the loss of that individual, financial loss of that individual. So, who are the persons who are having that insurable interest? That is your own personal self. Or suppose the person is dying, then the spouse is having a financial loss. The employees of the organization will have a financial loss. The suppose it is in case of an employer, the employees will have a financial loss. Suppose it is the bank, then the borrowers are the insurable interest, and the students and visitors in case of educational institutions. So these are the persons who are having the financial loss in case of the personal accident insurance. So a company taking a personal accident policies for its factory workers, most of the companies, it might be education sector, it might be manufacturing sector, or maybe service sector. Most of the companies are now availing the personal accident policies with a very meager premium amount, which is paid by the company itself. Most of the companies are paying, and in that case, the any employee who is facing an accident will the coverage will be given by the insurance company to the family. Suppose accident takes place and the person he has become disabled. It may be partial disability or it may be permanent disability. So in that case also, the compensation given by the insurance companies or the coverage varies. So types of disability can be permanent total disability, in which, so let us assume that the person has lost both the eyes or legs or one eye or one leg. So in that case, he is permanent disabled person. He will not be able to perform his work as a normal person. It can be permanent partial disability, loss of finger or toe, and it can be temporary total disability, cannot work temporary for a few weeks. Suppose a person's spinal cord is injured and he has been given asked for a bed rest of 4, 5, or 6 months, and within that 6 months he cannot do his go back to his duties. So in that case, it is a temporary total disability. So here, as per the disabilities, the compensation also varies. So when it is permanent total disability or permanent partial disability, then the compensation is 50 to 100% of the capital sum assured. So if sum assured is the amount which is mentioned in the policy during the time of opting the policy by the insurer, by the insured person, by the customer. So now, if the person is totally permanently total disability happens, then he will get 100%. If he is permanent partial disability is there, then he might get 50%. It ranges from 50% till 100% of the sum assured. Similarly, when it is a temporary total disability, then the weekly payment of to 1% of the sum assured will be there, because he will not be able to go back to his work. He will not be able to get his salary. So in that case, the person who is having temporary disability, then he will be getting a weekly payment up to 1% of the total sum assured, and this he will get maximum up to 104 weeks. The most important principles which are applicable to such type of policy is contribution. The contribution which is not applicable here, but subrogation applies here partially, and proximate cause, of course, here the cause of incident is accident. That is why the person has become disabled. It can be permanent or temporary. disabled. But the contribution principle, where more than one insurance policy will provide the compensation, does not exist here. The In case of a disability policy, here in accident policy where disabled clause is there, in that case the full claim can be made only under one particular policy. It cannot be distributed among different insurance companies to avail policy for one particular incident. So it has to, so the principle of contribution is not applicable here, but the principle of subrogation applies. So now, if the person is injured while escaping a fire, then it will be considered, because fire is by chance and it is accidental, so he will be covered under the policy. But anything which is not mentioned in the policy, any sort of risk which is not mentioned in the policy, will be excluded. So injury due to a risk which is excluded from the policy will not be covered. So his claims will be rejected. So in case of personal accident packages, there are exclusions which may not be mentioned in the policy, and there are certain addendums also which you can add on to the policy, but there the premium rates also will be higher. So major exclusions in the personal accident packages or insurance schemes are the intentional injury or suicide, alcohol and drugs, which we have discussed, the criminal acts, war and nuclear risk, pregnancy and childbirth, and armed forces services. So all these are exclusions which cannot be claimed if suppose there is accident. Suppose you are an army person, you are taking a training in the armed forces, and at that time you have been incurred with an injury. So that cannot be claimed as a accident in case of for claiming the personal accident insurance. So these are certain major exclusions. Now, when the risk is higher, the premium is of course higher. So it also varies. The premium also varies with the profession or occupation of that person. So in the previous slide, we had discussed here that in the principle of utmost good faith, the person has to declare what sort of occupation he has and what are his hobbies. So here in this case, when the risk is higher, then the premium will be higher. Depends on the occupation also. So when a teacher or doctors or bankers who are having desk jobs, who are just moving outside in vehicle, going to their office and then just returning back to their home, in that case the risk is low. So here for them, for this type of occupation, the premium is less because risk is also less. So medium risk is for the builders, the contractors and the supervisors, and very high risk is for the persons who are into mining, who are into business of explosives and the sports, because every time they are exposed to certain maybe chemicals or maybe the different types of hazards, or sports again, you are moving out every time for sports activities. So based on the occupation also, the premium is rated higher or lower. A miner pays higher premium than an accountant. So this is an example of based on the occupation. And the personal accident policies and schemes here, the entire family can be coming under one particular scheme. As we discussed that in an organization, employer opts for a group personal accident policies for employees as well as students also, in case of educational institutes. For now, Janta personal accident insurance, that is coverage by the government, student safety insurance schemes, and PMSBY schemes for a coverage of 2 lakhs. It is given pan India to all the persons, and a premium of only rupees 12 is deducted from the bank account every year in the month of March. Now, suppose the accident is not caused, because all these personal accident schemes that we were discussing now, that is within a particular country. But now, suppose a person is has been traveling outside overseas and faces an accident. So in that case also, there is a provision of overseas accident and health insurance. It is a package insurance policy and which is under the miscellaneous insurance. It covers medical emergencies, personal accident, and loss of checked baggage during the overseas travel. So suppose you're traveling from India to a foreign country, then suppose there you are having a heart attack, or suppose there you have faced with an accident, or suppose during the baggage there is checking of the baggage, there is a theft during your travel. So all this will be covered under one overseas accident policies. So these type of policies are Videsh Yatra Mitra policy, now, which is a outbound policy for Indians traveling abroad. So when Indians are traveling abroad, then this type of policy can be opted. Videsh Yatra Mitra policy, which from the age of 6 years to 70 years can be coming under this policy. And now from the foreigners who are traveling to India, they can offer the policy which is Destination India policy. So this is an inbound policy and the other one is outbound policy. So all these above events that we had discussed, the medical emergencies, personal accident, and loss of checked baggages will be covered under these two type of policies. So key coverage will be emergency medical treatment and evacuation, personal accident coverage, total loss of checked baggage, and loss of passport. So here the cost of issuing or getting a duplicate passport also will be covered. So, and what are the important conditions of for those persons who are going to be to opt this policy? Important condition is policy starts from the day of travel, or the policy or the date on which the policy was issued. So policy will start from that date, whichever is earlier. 7 days automatic extension for public transport delay. Suppose there is a delay in the public transport, so this policy can be automatically extended to 7 more days. Journey must begin within 14 days of policy issue. So if the policy has been issued on a particular date and you are planning to travel out to maybe some other country, so journey should begin within 14 days of the policy issue. And baggage delay beyond 12 hours consider covered for after the verification. So suppose you are lodging a claim for the loss of checked baggage. Now you are not going to getting your baggage after it is being checked. So only after 12 hours of the baggage checked, you can claim for the amount to the insurance company. Valuables and partial baggage loss are not covered. Now suppose the entire baggage is lost, then that will be covered under the insurance policy. But suppose you got your bag and you are telling that I had such valuables inside, I had 20,000 rupees or 50,000 rupees in the bag, then that will not be covered under this policy. Yes, the total loss of the baggage will be covered under this policy. And what are the major exclusions? Let us see the major exclusions. Major exclusions are pre-existing medical conditions. That means suppose you are already having certain medical history of disease, then that will be excluded. Travel against medical advice. Suppose doctor has already advised you to stay back and not to travel, then you will have any sort of medical emergencies. So in that case, it is excluded. Your claims will be rejected. Travel for medical treatment will be excluded. If you are going itself, the purpose of your moving out is only for medical treatment, then any sort of medical emergencies will not be covered or under the claim settlement. And claims where treatment can be delayed till return to India. So Here, if the treatment can be delayed after you return to India, you can be treated. In that case also, these cases are excluded. So in these certain cases, the claims will be rejected. And employment and student policies, these are policies for persons who are above 18 years to 60 years of age, and the sum assured is up to 75,000 US dollars. It covers the spouse and children with an extra premium charge, and medical expenses up to 5,000 US dollars, including treatment in India after return, can be covered. So this is a brief detail about the overseas accident policies and health insurance which is available both for the person who are going and traveling outside India and for the persons who are coming to India for traveling. So this is about the personal accident insurance. Now let us move on to few other type of insurance schemes. One of them is burglary insurance. So burglary, as you know, it is theft, but it's not a normal theft. It is something which is very violent or it is very forceful. So burglary means theft involving forceful and violent entry or exit. Suppose you are sleeping at night at your home, few dacoits come to your violently, forcefully come to your home, and you try to resist them. And in that case, they conduct theft in your house. So, in suppose there you have lost, you have been injured, or your property has been lost, your gas has been lost. So, in that case, it is a burglary insurance. So it is not a swift theft, rather it is a forceful theft. So force may be used against the property or person. So it may be used against, suppose they want to take something forcefully from you. So it is a forced uh, force for property, or suppose for the person. Simple theft without force is not covered. This is very important here. It is not a simple theft insurance. It is a simple theft, but it is a theft but with force. If it is not without, suppose you are not there in your house, you have gone to travel somewhere outside, and there is a theft inside your house. So, and you have lost some of your cash. So, in that case, it will not be considered under the burglary insurance, and the claims will be rejected. So so here it is bound that someone has to be there in the house and someone might have tried to resist. So it is a forceful theft which is covered under the burglary insurance. So the loss or damage to premises, that means suppose they have come, the persons have come and they have destroyed, damaged your house in somewhat, or property, or suppose the almirahs, the refrigerators, or suppose any other things they have damaged, or they have taken cash. So that is coming under the burglary insurance. Loss of cash must be supported by proper record. So if you say that yes, I had 1 lakh rupees, 2 lakhs rupees, or 50 lakhs rupees, so you should have a proper record, maybe a statement, bank statement, when you have uh, taken out that much amount, where you have kept, any sort of records which will support your proof, support your words that yes, this much amount of cash was there in the house. Then only it will call for a claim settlement by the insurance company. Policies, these such type of burglary policies also can be combined with few other policies like burglary private dwelling policy. So in this case, a house owner can take a home insurance policy plus a burglary cover together. So here this will call for a additional premium amount. So you will have a house insurance, home insurance. Suppose the house is catching fire anytime, so there it will cover under home insurance. But along with home insurance also you can cover the burglary incident. So there your premium will be, it is an add-on to the burglary insurance, to the home insurance. So similarly, You can also combine with shopkeeper, office guard, all risk package policies. Like a shop or office can take up fire policy, it can take up burglary policy, cash, equipment, liability, all under one single policy. So there can be combination when it is a miscellaneous policy. There can be combinations of different types of risks which are associated with that particular individual or with that particular organization. Suppose it is an educational institute. So educational institute can take a fire policy. It can take a policy of the employees for accident. It can take the policy for the employees for the students for accident. It can also take the policy for safeguarding the building as a whole. So there can be different policies in one as a package under one policy, and the principles which are applicable for such type of burglary insurance is same. Here the principle of utmost good faith has to be there, because when you are declaring that such type of theft has occurred in your house, so like suppose what is the amount of cash, what property was destroyed, everything will be should be disclosed in the proposal form for the claim settlement. The principle of indemnity also applies here, because you have to declare that maybe 10 lakh rupees has been lost in the form of cash or property loss. So that much amount will be again released on the terms of claim settlement. So that is, so principle of indemnity also applies here, and the principle of contribution also will apply here. So for one particular building or for one particular organization, you can have policies from different organization, insurance companies. So here part payment, some amount can be given by one insurance company A, another amount can be given by insurance company B up to the limit of the insured amount. So all these principles will be applicable for the burglary insurance. So there are certain exclusions of this burglary insurance also, like loss involving insured family members or staff, riots, strikes and terrorisms, losses found during stock taking. Suppose in an organization you are taking a stock and you found something missing, so that will not come under burglary insurance. Document securities, books of accounts, unless it is insured. Suppose in the policy it is mentioned that the document securities and books of accounts also is covered in the policy, then it will be taken care while settling the claim. And war risk is also excluded. Now some add-on aspects also you can add in your policy with a high premium, with the additional premium, like riots, strikes and terrorism, damage to documents, drawings, computers, data, etc., and derby's clearing and restoration costs. So all these things are optional. We can add, have an extension to the existing policy with a higher premium cost. When you're settling the claim, the evaluations and conditions are that it will have an average clause which is applied in case of underinsurance. Valuation is based on the market, the value of the amount of the expenses, so the amount of the burglary that is happened, the amount of loss that has happened during the burglary, it has to be evaluated, or the value has will be based on, valuation will be based on the market price or the reinstatement value. So the first loss, in case of the first loss policy, so in that case the average clause will not be applied. But after that, when it happens, incurred, the loss happens in frequently in future also, so in that case the average clause will be applied. So they have to take the average of the amount of loss at different incidents. So insured must take steps to minimize the loss, and claims should not be it should not be exaggerated for to a higher limit. And claims procedure is that in case of burglary, since it is a forceful theft, so in that case the individual has to have a complaint with an FIR, it is mandatory. And the claims, because since you are declaring that we have this much of amount of cash or property with us, so in that case the surveyor or the assessor also goes and assesses the loss, and insurer may insist on improved security and policy reinstatement. So these are the exclusions and extensions while and the valuation and claim settlement for a burglary insurance. Now let us move on to the other type of insurance, which is known as money insurance. Similar to the burglary insurance, but very important in burglary insurance is that it is a forceful theft or it is a forceful happening. But here in case of money insurance, here it is a bit modified form of the burglary insurance. Here it covers only the loss of money, not just the property. What is covered? So here it is covering the cash, it is covering the kinds of cash like checks, drafts, postal orders, money orders, postage and revenue stamps. So these can be covered under the insurance, money insurance policy. So where money is covered only, and the money in transit also is considered here, like when the money is moving from one place to another, from one bank to the insured premises. Like suppose from bank to a particular insured place, or from one branch to another branch when the money in transit in a vehicle. In that case also sometimes theft can take place. And the premises to bank, that means from your strong room to the cash counter, then the cash withdrawn for wages. Suppose a organization, a factory, it has withdrawn cash to pay the wages. So when the money is in transit from one place to another, in that case also the money can be lost. So first and foremost is money should be in safe or a strong room, and money at business counter should be there, because if you are taking from the strong room to the business counter, there has to be a partition or counter where the money is safe. And sum assured is fixed, a maximum amount in transit at one time. One time, what is the maximum amount of transit? Like suppose at one time from one branch to another, the maximum amount of transit is 20 lakhs. So then the highest sum assured will be 20 lakhs. Or in some case where suppose you are withdrawing the cash for payment of wages. Suppose every day you withdraw a cash of around 2 lakhs for the payment of wages. So that is your sum assured. Aggregate amount handled during the policy period is the total cash which is handled in a particular year. So you are calculated. So it depends. It varies from situation to situation. What should be the sum assured, which should be fixed for a bank or for an organization, or for an organization, as the case may be. It can be fixed on the maximum amount in transit at one point of time, or it can be fixed at an aggregate amount which is handled during the entire policy period. There are also certain money insurance exclusions and extensions. So exclusions to this money insurance where the claims will be rejected is shortages or accounting errors, loss due to fraud or dishonesty of the employees, if there is a loss because of the internal employees, entrusting cash to unauthorized persons, if you are entrusting cash to any person who is not authorized to deal with the funds, then a loss covered under other policies, riots, strikes, terrorisms. This loss can be also taken as a addition. It is initially it is excluded in the basic policy, but this type of incidents like riots, strikes and terrorism can be added as a extension. Loss due to use of keys without force. and theft, which is a simple theft, and money carried under contract of affringement. What is this contract? Here it is a legal contract for transportation of goods or cargo. Suppose money is shifted from one place to another under an agreement, and that person is actually, that transport company is actually, or shipment company is actually responsible for the money transport. So in that case, insurance company will not settle the claims. So these are certain exclusions for money insurance policies. And what can be addendums, add-ons? Add-ons will be fidelity of employees. Fidelity of employees means the any dishonesty work, or the mistrust or by the any employees, any fraud by any employees of the organization, that may be covered, or an extension can be taken. Riot, strike, and terrorism can one of the extensions. Disbursement risk. So when you are disbursing money from the bank to any other organization, so in that case also there might be any case of cyber frauds, so there also it can be added. Money in the safe. Safe means a strong safe where you are keeping the money, so theft can have be from the safe also. And the money at the business counter. So business counter, the place where you are going on disbursing the amount cash. So these type of addendums can be added to the money insurance policy also. But here in such case, the individual or the company has to pay extra amount as a premium. The important features are: average clause do not apply here. Premium is adjusted based on the actual money handled. Excess or shortage may lead to refund of the extra premium. And FIR is required because if when it is a money theft, so of course FIR is required when this is loss of money. So, and the claims are very minutely assessed by the surveyors or the assessors of the loss. And widely such type of money insurance is used by the banks, shops, petrol pumps, and retail outlets. So in case of money insurance, here this risk can be reduced through digital payments. Another type of insurance is fidelity guarantee insurance. Fidelity guarantee insurance covers the financial loss which is suffered by employer due to any fraud or dishonesty which is committed by any employee who has been entrusted the responsibility of dealing with the money. So such type of employees might be dishonest sometimes with the organization. So that in that case, in case there is a money loss, so in that case there is an insurance which is known as fidelity guarantee insurance. So it covers loss due to dishonest act of employees. Fraud may occur slowly and secretly, unlike burglary. So here it is nothing forceful. When he's handling the money, there might be any incident which might call for his own dishonesty or mistrust. So loss may be detected not immediately, but loss might be detected a few years later. So such loss are insurable subject to the conditions that such loss are insurable by the fidelity guarantee insurance, but there are certain terms and conditions, certain exclusions, certain inclusions, and certain addendums which are defined properly in the policy. So there are types of fidelity guarantee policy, like commercial fidelity guarantee. Here the fraud by employees in the private organization. Court bonds for court appointed officials handling money, and the customs and state excise bonds for government revenue related roles. So these are different persons who come under this fidelity guarantee policy. So key difference between this is that in burglary it is external force is there, but in fidelity it is very swift, no one knows, and you are having internal breach of trust, and it may not be known immediately also. The coverage are loss caused by employee dishonesty. Employee must be in a position of trust. Loss must be detected within 12 months from the date of trust. as we said that the loss may not be detected immediately. So the important conditions are the loss must be reported to the insurance company within the 3 months. Employer must take internal control measures because they should check their accounts books without relying on every person always. So there should be continuous checking of the books of account. If employee is reinstated, insurer not liable. If the employee is again coming back to the office to his own position, who has already breached, already made a historical record is there, he has lost the trust of the employer, then in that case, the insurance company will not pay the claim. The contribution applies if multiple policies exist. So principle of contribution will be there. Insurer has the right of subrogation against the employee. That means the insurance company will pay, and that amount the insurance company will claim from the employee who has due to which the loss has happened. So that is a right to subrogation, and insurer may terminate the policy after the claim is settled. So, and there are the types of policies can be individual policy for one employee, collective policy for the entire staff. It can be a floater for group of sensitive positions. There can be position specific policies for person in specific designation. There can be a blanket, which that means there will be unnamed employees. It will be a group of employees, but employees will be unnamed. And excess floating, insured bears minimum loss. So these are the various types of policies which are under this policy of fidelity. So proposal form focuses on the moral hazards, the employee details, past employer references, and the nature of duties. Another type of policy is bankers blanket indemnity insurance. Here, the bankers blanket indemnity insurance is a comprehensive policy which covers the banks against losses arising out of fraud, dishonesty, forgery, and related operational. So, this type of policy is specifically for the banking sector, banking organization, where the employees of the banks who are handling sensitive profiles, so it is arising due to their fraud and dishonesty. So banks handle large amount of money, securities, bullion, and valuables in trust. Losses may arise due to fraud, negligence, forgery, or dishonesty by employees or the associates. Bankers blanket indemnity insurance provides a comprehensive cover against such type of losses which are due to the employees of the organization. It is called a blanket because in under one policy there are different types of risks which are covered. So this coverage will include money and securities on premises, money and securities in transit. That means if money and securities are there in that branch itself, it will cover those amount of money. If the money is transferred from one branch to another branch, then it will cover forgery or any alteration in the books of accounts, dishonesty by any of the employees, any hypothecated goods which is not existing but it has been mentioned in the records, and the registered postal sending. So all this will be covered under this blanket indemnity insurance. So the loss involving appraisers, agents, and business correspondents. It is one policy where you are covering different types of multiple banking risks. So excess clause is insurer may fix an excess portions of loss borne by the bank and encourages care of internal control. So this is the main essence of this entire policy. Here, in case of this type of blanket indemnity insurance, there is a clause which is known as excess clause. Here, suppose the bank has lost around 2 crores rupees, then it will be mentioned in the policy that the bank has to bear, let us assume 30 or 40% of the entire loss, and the less amount can be claimed from the insurance company. So here the banks are forced to or encouraged to take their internal control always to monitor the activities at frequent intervals, and it will help the banks not to be more casual in their approach in handling the money. So here the insurer will fix an excess a portion that will of the loss that will be borne by the banks, and excess will not apply to any fire, riots or strikes and burglary. It is only when the internal employees are making any fraud the excess will apply. So policy and sum assured after the claim settlement policy must be reinstated. Basic sum assured starts from the day of inception and is revised every at every renewal. So every year it will be revised. And major exclusions to these policies are wrongful acts of partners or owners, losses due to trading, properties security not properly described, war and nuclear risks are excluded, loss due to faulty computer programs or data loss, natural calamities, losses by employees with known adverse antecedents. All these are known things which are excluded or which will be mentioned in the policies which are excluded in such type of banking blanket indemnity insurance. The policy can be cancelled within 15 days of notice, and premium for unexpired period may also be refunded if there is no claims. Premium will be depending on the nature, number of employees and the number of branches, banks. So this policy is specifically for the banking organization. Another type of insurance is jewelers block insurance. It's basically for jewelry shops. The jewelers block insurance is a comprehensive policy designed specifically for jewelers, covering jewelry, currency, and valuables against multiple risks at a shop. It is in the shop, in the premises, as well as when the jewelries are being transferred from one place to another. Maybe when you are going to highlight your jewelries in an exhibition, it is during that transit also that is covered under this jewelers block insurance policy. So what are things which is covered? Jewelry and currency on premises. So in the premises, if there is fire or any explosion or lightning or theft, riot, strikes or any malicious damage. Jewelry in custody with employees, partners, authorized third parties while on displays in exhibitions. So it is in custody of a particular person, and if the person, the internal employees only conducts any misconduct or theft, so that is jewelry in custody, which is covered under this policy. Jewelry in transit, when the jewelries are shifted from one place to another, furnitures and fittings damaged due to insured risks. So all these things will be covered, and this is specifically for a jewelry shop. So one policy protects the jewelry inside the shop, outside the shop, and also on the move. Exclusions can be processing losses, shortage found during stock taking, loss by owner, partner, or their spouses, that will not be considered. Theft from unattended vehicle, the person will be there, then only it will be considered. Loss due to wear and tear, depreciation, air exposure, damage to fragile items, dishonesty of the employees, theft after business hours, consequential loss, and war and nuclear risks. So here there are certain important conditions like cost plus valuation will be on the cost plus percentage basis, valuation of the premium as well as the valuation of the claim settlement. Fraud of such type of activities should be reported within 60 days. Policy complaint is mandatory within police complaint will be mandatory within 24 hours of the theft. Full claim documents should be submitted for claim settlement with the insurer within 14 days. Investigation will be done by the chartered accountants or the assessors. And the security classification here or the risk rating, when it is class 1, 24-hour watchman in a shop, if there is 24 hours watchman, then it is having low risk, so premium is less. In class 2, then there is a common watchman, then the premium might be a bit high, and there are in class 3 there will be other risks which are associated. Lowest premium is called for when the shop is having a very secured premises with CCTV cameras and the arms guards. Other miscellaneous insurance are pedal cycle insurance, which covers loss damage due to fire, lightning, explosion, burglary accidents. Limited to third party liability is included. Wear and tear is excluded. So here the sum assured is generally the within rupees 10,000 to 25,000. Similarly, another type of insurance like television insurance, which covers accidental damage to TV and fittings. Plate glass insurance, which covers the breakage of fixed display glass in shops. That may be due to riots and strikes also. Neon sign insurance, which covers accident loss damage due to accident, fire, lightning, explosion, and theft. It can be due to short circuit also. It can be damaged neon signboards. Other miscellaneous insurance can be sports insurance, which covers sports equipments and apparels. So here personal accident covers for the players. Usually the age is from 10 years to 70 years. Pet dog insurance is also available for pedigree dogs, and the age limit is from within 2 months to 8 years. It will cover a death due to accident or disease of that pets. There can be missing document insurance also, like it covers the loss of original documents. There are also certain package policies. So what are these package policies? Package policies are combinations of multiple insurance covers under one policy, and this will avoid missing important covers and eliminates multiple renewals of the policy, and also it offers a broader protection at a very cheaper cost in compared to every individual policies for specialized products. Common risks which are covered under this type of package policies are fire, lightning, explosion. There will be might be aircraft damage, earthquake, impact damage, burglary. These are some risks which are covered under this package policy. This is very simple. Under one policy there will be several covers, and here the premium is also at a cheaper cost. Major types of package policies available are household insurance. They are for only household jewelries or any sort of cash which is available or property available in the household. Insurance, shopkeepers insurance, it can be a package for the LPG dealers who are providing LPG cylinders. It can be packaged for doctors, which includes professional liability insurance. It also includes office protection shields, and the package policy for small credit societies also are there. Package policies, there are certain unique covers and new trends also. Unique covers and add-on features will be there for these package policies, with a subject to a condition that you have to pay more premium for that. There are policies like Adhikari Suraksha Kavach also, where it will cover the loss of your valuables like laptops, mobile phones, or any other documents like mediclaim or personal liabilities. Specialized covers in the new trends like the total abandonment of sports, matches or events, kidnap and ransom insurance, intellectual property right insurance, where there is loss of copyrights, trademarks, patents, and know-how, and e-commerce cyber risks are also available. Are also they are very predominant today, and along with the online business risks. So this is all about the miscellaneous insurance policies which are available in today's scenario. In the next session, we will be starting with the block 4 of this course. Thank you.